Have you ever seen price break out below a low, got involved to go short or long to ride the move, and then just seen your stop loss get absolutely blitzed and price run in the opposite direction? This is literally a turtle soup in motion. And today what I want to do is show you exactly how turtle soups work, how to trade them, and how to integrate them into your trading so that you can take higher probability trades. So we're just going to do a little bit of theory, focusing on what is a turtle soup, why do they work, how to identify turtle soups, and then how we trade them. And we're going to look at two examples: Australian New Zealand dollar and Euro GBP. And from there, we're then just going to finish off with a couple of must-haves and common mistakes when trading turtle soups. By the end of this video, you should be very confident on turtle soups, and by integrating this stuff in line with other concepts, other parts of technical analysis that we run through on the channel, you are going to become a much better trader. So let's start with what is a turtle soup. So the definition is a false breakout above or below a key level, which is an old high or an old low, before reversing in the opposing direction. So visually, how does this look? Price is buy to sell, retrace, buy to sell. It's breaking out below the low here, marked as the turtle soup low. Then what happens? Price rejects that level after looking like it's going to break lower. It then breaks higher, disrespecting the supply, in this case, this being a bearish to bullish example, retraces into the bullish demand that is created at the low, and then heads back in the opposing direction. So as a chart pattern, that's what a turtle soup looks like. But what is actually happening, and why do turtle soups work? So they are predominantly liquidity traps. So smart money, if we call it smart money, institutions, whatever you want to call it, is looking to trap traders with false breakouts. So the concept being, retail traders love breakouts. Someone that is looking for aggressive price action in one direction that they want to just then ride in the continuing direction. So they see that breakout, they're not really taking account of where price is in relation to old highs or lows, and they place their stop levels at the corresponding high that sits probably just about above where the breakout is actually occurring. So what happens as price breaks below that level is that stops get introduced into the market. A lot of liquidity gets introduced in the market that then institutions, point two here, can then buy into to accumulate large orders in the market. So if you think about an institution that wants to maybe transact hundreds of thousands of units in their position, they need to fill large orders. So they need to manufacture liquidity. And the best way to do that is to build the impression that there is going to be a break below a level, obviously where stops are already sitting, to entice new entrants into the market that they can then counter trade against and use as liquidity to fuel a break in the opposing direction. If you think about the psychology of what happens around turtle soups or breakouts at these levels, they also create a lot of FOMO. So retail traders will buy breakouts first and foremost, and then as that breakout's occurring, more people are starting to load into positions. So again, it's about that psychology, that ability to create FOMO that entices more liquidity into the market that institutions can trap in order to ride opposing trade direction. Finally, candles, as I talk about all the time, are ranges in their own right. So we're not going to spend ages on that as a concept right now. There are much more detailed videos in my channel. But breakouts below old lows or above old highs are in fact higher time frame candle liquidations. So if we get confirmation that we are going to reject those levels, we open up very clear targets that we can take counter direction trades towards. So they become not only something that from a pattern perspective we can trade, but from a higher time frame perspective, thinking about how candles tie together, they give us very clear points in the market that we can take either swing positions or day trades, depending on the time frames that you're analyzing. So that's why turtle soups work. How to identify turtle soups? You have to analyze key highs and lows. And I do that through analyzing higher time frame candles. You need to see first a failed breakout, so a push below a low, and then a confirmed rejection of that level that we can then trade in the opposing direction. So let's get into it with some examples and look at how to trade turtle soups. So we're going to start with AUD NZD. And what we're looking for, based on what I've just said, is a downtrend in a bearish scenario. So we're getting highs respected, lows broken through, a raid of a low right here, and then a shift, and then a counter trend trade. So this turtle soup is the raid of the low. And it's not just any low, like why this low versus this low? We're not looking at lows necessarily, stick with me, on the same time frame. We can look at things like internal range liquidity, but right here, what we're looking for is lows on higher time frames. So this would be a key level of, for example, a higher time frame candle. So imagine now you're looking at the monthly candle, and here we're sitting on, say, the 12-hour chart. Here we have the monthly candle. Here we have the low of that candle. And on our 12-hour chart, we're raiding this low. Then we get a true structure shift right here. And then we get internal range liquidity that sits in this area right here that we can use to take trades. Something like that. And where are we then targeting? Probably the opposing end of that range. So that's essentially the model for turtle soups. And I'm going to show you some examples here. So if we look at this in isolation, we're on the 12-hour. We don't really have any higher time frame context here. And I'm not going to jump around time frames. I'm just going to overlay a higher time frame candle right here. So I've got the monthly, which I could use, or I could use my mid time frame, which I tend to use from swing positions as either the 2-week or maybe the weekly chart. So I'm going to leave it on the 2-week for now. So we have this price action right in front of us. I'm just going to mark this very clearly, whereby we have bearish price action in the market. So we have highs being respected, lows being broken through, new highs, then failing to take out lows. We then have one more try, fails to break below the low relative to this leg here, break above the high. So we have that pattern that emerges. We take this away and we just look at purely price action. High, low, high, break through the low, high, fail to break through the low, new demand stepping into the market. We get our shift. And now we're looking to run that counter trend idea. Why is this something that we would want to do? Because we are liquidating a higher time frame candle. So in this entire range of price, we have a 2-week candle. And what this does right here is confirm that this candle is printed. The new week opens, week 1 raids the low, week 2 respects and then continues higher. And then what we can do if we want to further verify this is maybe take a look at the weekly time frame, and we can see that we also have weekly liquidations of this candle here. So obviously these two candles combine to make the 2-week candle. These two candles combine to make the subsequent 2-week candle. So if we just take this box in, we have an accumulation candle, a manipulation candle below the low, a respect of the low, and then a shift. So we can use this exact action to understand what's going on. It's a 2-week turtle soup. Soup of the low, breakout, enticing new traders in that are looking at this price leg here. So for example, there's a fair value gap right here. I want to take a short right here. You've seen a liquidation of this candle, so it would be valid potentially to take a very opportunistic short here, but bear in mind this bullish price action. So more and more liquidity is accumulating at this high. And then what happens? Very aggressive price action, very aggressive. And there isn't really any let up. Once the move happens, it's trapping traders. It's not letting anyone that wanted to get out of this position escape, and it just trades straight to the high and actually way beyond the high. So once you get your structure shift, you've got your liquidation, then you can start to trade this idea. If you want it to be very conservative and just cover the low, like more as a position trade, you still have a 1.28 to the corresponding 2-week high here. However, we can use other concepts, internal range liquidity, perhaps lower time frames, to really refine this. Even if you just cover the liquidation within this leg here, you have a nearly 2-hour trade. If you cover the fair value gap, 4.95 hours. So we're not talking today about how to execute trades. We're just talking about that concept of turtle soup, the actual mechanics of price action and the reason that price trades in the way that it does in relation to turtle soups. So to make things easy, I'm just going to give you another example right here. Again, using 2-week lows, because why not? We're staying on the same point. If I just take this away right here, we can see, actually we'll just use this high. So price action is, we have this bearish price action come in, but we still are coming off a bullish leg. So price eventually does start to make its way higher. So we do have lows being respected, highs being broken through. We get that again. So we get a candle closure above the high and a big push up. So this type of price action right here is really enticing new entrants into the market on all time frames. But even if you were just using this time frame, you've got an order block right there. This looks like a winning trade, but you're actually entering right here. You see, you just get stopped out immediately. You've got other position traders maybe seeing this as a break of structure, and so as price makes its retracement into this order block, new traders are getting involved. So liquidity is being manufactured in this breakout, and it's being done in a host of different ways to ensure that as much liquidity is building in this particular area of the chart. And then what happens is that we get a retest of this price leg, a push, and if, just to make this explicit, more liquidity entering the chart. Okay, we're getting respect. We have an order block. We're going to go long. We're going to break the high. We've got a 2-hour trade. Again, it just gets sold off. And then what happens? We get that shift in order flow, which you can see in another video of mine, how to map order flow. And then you start to get the sell-off. So if we go back to the mechanics of a turtle soup, we can see high being liquidated. We can then see true market structure shifts right here. And so then we have points of liquidity in here where we can take counter trend trades. And if I now bring in the 2-week time frame, we can see exactly what is going on. We get a sell-off. This is probably like the first week here, and we're liquidating the first week of this candle. But remember, this is a 2-week candle. It's enticing, and even in this price leg, it's enticing people into going short, which then liquidity gets hunted in that very aggressive move up. Then we actually get the true turtle soup, the liquidation of the accumulation candle. So we have our accumulation candle right here, candle 1. Then we have candle 2, manipulation candle, which is then manipulating above the high. We get eventually our structure shift following the breakout, and we've enticed all that liquidity in. Turtle soup of the high. This is seen in the formation of a wick. So It's not as clear with this indicator right here, but the actual body of the candle is right there. You see, that's actually where price opened and where price closed. The shaded area right there is the candle's wick. And what I'll do actually, just to make this even clearer, because this indicator is nice, you can actually see it's the exact same price action, but you can see the wick right there in the middle. So we have a wick liquidating this 2-week candle. We have our shift, and now we can take counter trend trades. So say we wanted to get in at the fair value gap and just cover the high. Where does it now make sense from a technical analysis perspective in using things like candle range theory to actually place our trades to target the low of the accumulation candle? So we have nearly a 3R trade to the low, and you get this manipulation back because there will be liquidity that builds within these candles on the daily and weekly time frame. But as long as you have the right read on the right higher time frame candles, you have the right read on your pricing, your execution time frame, in this case we're looking at the 12-hour, then you can confidently get in and out of these moves and take the relevant positions. So we looked at firstly AUD, NZD, 2 cross pairs, then Euro GBP, another cross pair. We've got a bullish example here, we've got a bearish example here, and we've covered the whys as to what is a turtle soup, why do they work, how do you identify them. We're just going to close out with some must-haves. So we need a clear key level. We need a clear sweep and rejection of a key level. So I don't place my trade up in this wick. There might be those that use lower time frames to time almost liquidations, turtle soups on these lower time frames right up here in the wick to get a much better entry. But of course, at this point here, you don't have that 2-week candle close. So to be very safe, you can actually just wait for this candle to close, confirm your rejection with this wick, and then trade the counter trend move. You need higher time frame context, being the higher time frame candles, whether that's if you're swing trading weekly, 2-weekly, monthly candles, or even more. If you're day trading, maybe daily candles, 2-day candles, 12-hour candles. And then obviously you need your execution time frame to map these sweeps and rejections. And then you need clear targets, and that can only really be derived from understanding higher time frame candles, which comes back to candle range trading, which is something I talk about a lot on my channel. Common mistakes: trading every failed breakout. So price will liquidate levels, find support, and continue in that direction if you don't have the right higher time frame levels marked. If you ignore higher time frame context, you're just going to get eaten alive trying to trade turtle soups. You'll get one where you're lucky, 2 where you're not, and it just won't work for you. You need to wait for confirmation, in my opinion, using the time frame that you execute on. And then poor stop loss management. This is more of a separate topic, but once you get that shift, you really need to understand potentially either the lower time frames to find that execution point within the price leg that you're analyzing, or where key points of internal range liquidity exist that you can trade from, where to put your stop to know that you're safe, that you're not going to get stopped out before the move occurs. And I've got videos coming up on both stop loss management and internal range liquidity, so look out for those. Please subscribe to my channel. I trade 32 Forex pairs. I swing trade those pairs. I've got a lot of content coming that is going to hit the channel to hopefully make you as a viewer more profitable and getting into higher probability trades. So yeah, please subscribe. Thanks for watching, and I'll see you on the next one.